Ladies and gentlemen, good morning. I'm Paul Clements Hunt, your moderator for this morning. Most of you we've climbed to the top of Mont Blanc to get to room E, so we're going to start in a couple of minutes. But it's good to see you all here, and we will. I'll introduce the panelists. I'll keynote the panelists, and we'll have a really good conversation because that's what it's going to be. So would love the audience to be as active as the panelists. So be warned, I might come to you unexpectedly. So let's start in about 2 minutes, okay? But welcome. Okay, we're going to kick off so we don't lose too much time. Again, good morning. I'm Paul Clements Hunt from the Blended Capital Group, normally based in Nairobi. And welcome to Fighting Off Blended Finance, quotes, bad press, with new transformative financing models. I won't introduce the panel now. We're going to start with our keynote, who will frame issues for us. And I'm glad to say that we have Melchior de Muralt, a dear friend for a long time and a driving force in sustainable finance in Switzerland, who's a managing partner at Depure Pictet Turretini. So Melchior, the floor is yours to kick off the panel. And everyone, let's have fun, good conversation, and really dig into detail. So Melchior, the floor is yours.
Thank you, Paul, for this very interesting meeting. I will try to be very concrete, speaking about blended finance and potentially the critics about the limits of blended finance, and quite short, because then we will have an open discussion, even with you, of course. So in a nutshell, blended finance is the best example on how capital market can chase social and environmental impact, even in very risky context, in blending, partnering with public money and development actors. So let's take an example. More than 15 years ago, at Blue Orchard, initiated the first type of blended finance vehicle in order to invest in tier 2, tier 3 microfinance institutions, so the most fragile, in teaming up with public money, having in a debt fund an equity tranche financed by the German government, which was the first loss tranche, and then a mezzanine invested by IFC and KfW, allowing a senior tranche with a potentially even a S&P rating, attracting commercial investors, pension fund, insurance company, family offices. So in doing that, you help connecting to the unlimited sources of capital of the capital market. And that's very important to understand. Capital market, as far as they can connect with a proper risk-return impact formula, they are an unlimited sources of investment and financing. So that's why started blended finance. In the case of Blue Orchard, and a bit like R20 and the Subclimate Fund, we will discuss further later on with Albert, with David and Pegasus. We have as well each time a technical assistance pocket of donation money, helping to enhance and strengthen the portfolio companies through technical assistance on IT, human resources, you name it, to mitigate the risk and to accompany the growth of those companies. So those type of vehicle could be named blended finance vehicle. You have another type of innovative finance, blended finance vehicle we called impact bond. So impact bond are pay on result mechanisms. So you have social investors investing into a social project, let's say social inclusion, could be soil regeneration, things like that. And they will be paid at the end of the program through public money, paying on results, depending on a KPI matrix on social or environmental impact. ICRC launched such a bond in rehabilitation in Africa. The bond was paid off in July. So those type of pay on result mechanisms could be as well considered as a blended finance vehicle. So I will end there. The critics sometimes about blended finance is, okay, public money, taxpayer money is subsidizing those commercial investors, the rich or the capitalist. And in fact, I think the critics is unlegitimate because, in fact, before those new types of innovative financing mechanisms, the IFC-like investors were very much tempted to crowd out private investor, saying, okay, we'll do, that's our job, that's not your job, and subsidizing investment, creating then a huge distortion in capital market and making impossible for the capital market to flow long term in those type of impact investment. So in a nutshell, it's only the beginning of the road. There will be more and more. If you just in Switzerland, if you hear Cassis, our foreign minister, he said to SDC and SECO, we have, and that will be the good transition to SECO now, let's start to speak the same language and let's use Building Bridge as the platform for creating that new type of conversation. We need to understand each other, not to look at the private sector saying, okay, that's the bloody capitalist looking only at short-term profits and we are the right development investor. We need to join up on the umbrella of the SDG 17, saying, okay, partnership will be the only way to solve those huge challenges. I stop here, Paul.
Melchior, that is a perfect framing because I think it speaks to the transition mechanism from public to private, to scale, to capital markets, to the delivery of the 17 SDGs, SDG 17 collaboration that's at the heart of it. So Melchior, thank you for your open comments. And if you join us there on the panel, that's wonderful. And could I have the overall speaker panel up, please, if you would? Sorry, no, folks. I mean the slide. So look, I'm delighted to sweep across, building from what Melchior said, but obviously going now to the real heart of the public sector in some ways in Switzerland. And we're delighted to have Christian Brandley, who's the Deputy Head of Private Sector Development at SECO, which doesn't need any introduction. But Christian, the floor is yours to bring in that public sector perspective, perhaps government perspective, donor perspective, and the work that Switzerland does around the world is quite phenomenal. So over to you, Christian.
Well, thanks very much, and good morning, everyone. So I'm talking, yes, from a government perspective and from a focus on developing countries, because we're using official development aid. And let me start by saying that blended finance is something we have been doing without knowing it, because the term simply didn't exist 15 to 20 years ago. Today, blending is trending. We hear it everywhere at building bridges. And so I want to provide a bit of a context, some thoughts about concepts, and 5 learnings that we identified for blended finance from a public sector perspective, and how we are implementing them through a new joint initiative that is called SDG Impact Finance Initiative with our colleagues from SDC, UBS Optimus Foundation, and Credit Suisse Foundation, and hopefully soon many more. So on the context, I think we don't have enough quantity nor quality of finance for developing countries to achieve the SDGs and the Paris Agreement. I think that's clear for everyone. And this is even further exacerbated by COVID and increasing debt levels. While globally there is sufficient capital, it is not flowing sufficiently where it is most needed, nor with the right characteristics. So we think we need to work or work needs to be done at several levels. And I think the cascade approach developed by the World Bank Group some years ago is still a reference in my view. While not every initiative needs to work on every level, we need to cover them all collectively and coordinate this work in a smarter way. So one level is that we need apt policy frameworks both in OECD countries with regards to pension funds, institutional investors, etc., as well as in developing countries to attract more investments. Of course, a carbon tax will be best, for instance, in the area of climate, but currently we work with second-order solution. And I think that the investment climate in developing countries is really something that we need to continue focusing on. Second, investment pipeline, I think that needs to be developed partly with grants. This takes time, especially in the area of infrastructure. It can be either private or through capacity building of local governments, for example, PPP units. And while there are quite some preparation facilities out there, there seems to be a gap from the preparation facilities to real investment following up in the work that has been done by these preparation facilities. And I think sometimes it's a lack that, or they are working too much in isolation and maybe not creating sufficient local capacities. And I think we also need kind of a new kind of architecture in the area of the MDBs, because while MDBs should continue to provide technical assistance in the form of grants, their business model with regards to investments might need to adapt. And to put simply, maybe we need to go from an originate and hold approach to more of an originate and distribute approach. And I think this will require some changes in governance and incentives within the MDBs. So SECO has been supporting different actors to work on these different levels in the area of sustainable infrastructure financing. For instance, through the World Bank, we have supported capital market reforms and in emerging markets, as well as investment climate reforms more generally. And we also support capacity building for PPP units sitting in national and subnational governments. We've also been supporting regulations and voluntary standards, such as, for instance, in the area of sustainable construction that are applicable in and corresponding to emerging markets and that are applied increasingly by the financial sector. And for instance, through the private infrastructure development group PITCH, we support the creation of an investable pipeline in infrastructure and respective blended finance toolkits, including the use of local currency wherever it's deemed feasible. PITCH is a multi-donor initiative together with the UK, the Netherlands, and Australia that Switzerland initiated 20 years ago with these partners. So I think to take stock a bit of good practices from our side in the area of blended finance and from a public sector perspective, we identified 5 aspects that we think are critical to go forward. First, provide early stage technical assistance and funding to support innovative ideas, because it's usually at the early stages that concessional finance is most needed. If nobody invests at these stages, the lack of an investable pipeline will continue to be a huge issue. Second, to plan a series of competitive calls to assess value for money and additionality, which is critical from a public sector perspective, to exactly kind of react to the criticism that might come up. No? So we need to be we need to cover that front as well. And we think it is useful to institutionalize the offering of concessional finance and provide it to the best ideas in the market instead of providing ad hoc and one-off transactions. And I think the market is already more mature so that this is possible. Then third, pool catalytic funds to get better blended finance deals and reach scale. I think this is both important in terms of quantity, but also in terms of scope, and I will come back to this point later. Fourth, demand quality impact reporting to show that you're making a difference. Again, a bit to the criticism that potentially could come up, because from a public sector side, we need to ensure that there is a public good that we support, and so we need to see that impact. And also in this area to support market knowledge, to provide transparency and benchmarking as a public good, so to be able to compare impacts according to different instruments, regions, sectors, management fees, etc., to assess which are the best ideas and funding models to go forward. And I think the SDG Impact Finance Initiative that we launched actually 1 year ago at Building Bridges encompasses all these learnings in a very good way. The idea is to use blended finance that is pooled, so catalytic funding that is pooled for impact investing in developing countries. We want to achieve innovation and scale as well as ecosystem building, where we aim to gather 100 million of Swiss francs in grants or catalytic funding to leverage 1 billion of private sector funds for impact investing in developing countries. And we think that this pooling of efforts, knowledge, and funds brings multiple benefits, because while from an investor perspective you need to diversify risks, the providers of concessional finance for blending usually have institutional mandates that restrict its broad use, and therefore pooling concessional funding can help to overcome that obstacle and not only amplify the quantity, but also broaden the scope in terms of sectors, geographies, and instruments that we can use. And so the SDG Impact Finance Initiative is broadly grouped into 3 windows. One is the design funding windows that tackles this or supports these early stage TA and funding to provide an investable pipeline going forward. Then we have a second window that provides TA, first loss, and guarantees for maybe established funds already that want to expand and have maybe further impact or go into more difficult country contexts. And the third window around ecosystem building that supports research standards that need further harmonization going forward. So maybe let me share 4 key takeaways to fight off bad presses. This is part of the title of this session. I think with all the buzz and the hype about blended finance, we should not forget the importance of the work on investment climate, where grant money is key. So this can be more generally in the area of investment climate in developing countries, but also to develop domestic capital markets in emerging economies, and that's something that we want to continue working on. Then always be clear that blending is a structuring approach and therefore a means to an end. Also to apply blended finance principles as elaborated by the OECD, and I think in theory we agree, but there is still some work to be done to put them into practice, because it's quite a complex assessment, and that's why the whole knowledge work needs to increase, and I think that the benchmarking that comes out of this. And last but not least, focus on quality. I think to give an example, too often there's hard currency used where local currency would be a better fit, and we consider local currency really a key aspect for quality blended finance going forward. So yeah, that's maybe to conclude a bit. Thanks.
Christian, thank you very much. If you will join us on the panel. So Melchior and Christian have framed it wonderfully for a good conversation. Could I have the... Yeah, I've got it up already. That's good. So look, in terms of moving to the conversation and what we want to hear, we're not doing long CV or mini bio coverages. I'm going to bring you up onto the panel. When you first speak, I would suggest you give 15 words on what you actually do, okay? Is that cool? I'll call you up by name. So first of all, we've got Maya Zisweiler from the who's the CEO of the UBS Foundation, the Optimus Foundation. So welcome, Maya. Then I'd like Dorothy Hare, who's the manager Oceans Climate and Change at IUCN, as our international organization representative. And next, I'd like to call in Tobias Meyer, who's with Swiss Reinsurance. And last but not least, Parth Shah, who is the Vice President, Pegasus Capital Advisors. That means we've got an international organization. We've got very large potential investors from both the investment and the foundational side. We've got a specialist asset manager, and we have Seiko as well. That's a great panel. So what I'm going to do is I'm just going to loft a question, and I'm going to give it to one of you to kick off. And I'm going to wander over here, because building bridges, they make the moderators work for their lunch. There's no seat. I'm not allowed to sit down. So I'll be on my feet for most of this. But I'm going to come to Maya first in terms of, again, we want to get right down in terms of where we've been with Melchior and Christian in terms of the delivery and the reality on the ground and how you move funds and how we replicate and move funds at scale. So Maya, what have you heard? What's your perspective? Thank you. And 15 words on yourself.
Thank you. So thank you very much for the invitation to join this panel. So I'm Maya Zisweiler. I'm the CEO of UBS Optimus Foundation, and I represent the philanthropic side and the party within the blended finance structures. So maybe just a little bit about Optimus Foundation so you understand how and why we engage in blended finance. So we are an independent foundation, but we're aligned with UBS, the entity, one of the largest financial institutions. We've been working for over 20 years in education, health, and child protection, trying to solve some of the biggest potential issues. We are also have a vision around building a thriving impact economy where financial and social returns are valued. And we deploy catalytic funding at the initial stage where we try and build a pipeline of investable opportunities, whether that be through grant or social investment capital. We try to get that to scale through 3 routes: government partnerships, collective philanthropy, and blended finance. So blended finance is really core to what we do, and underpinning it all is really our work on impact transparency and standards. So why are we very well placed to do work in blended finance? We're linked to a wealth manager where we have access to philanthropic capital that can be used to de-risk structures, but we're also able to work with our colleagues in asset management and the investment bank to structure some of these solutions. So maybe then to the point about becoming really concrete, I want to give you examples of where we've done blended finance in 2 aspects. One is outcomes contracts, and you mentioned impact bonds, so I'll come back to that. And 2 is some examples in nature-based solutions, because we feel like there's a lot of potential in that space for blended finance. So starting with outcomes contracts, so you gave an introduction, so I won't go into what they are, but what we try to get out of outcomes contracts is a way to make sectors that are traditionally less investable, but also to make sure that we're actually linking financial returns to social impact on the ground. So that direct correlation. So we've been trying to build pipeline and track record in these types of instruments. The Quality Education India DIB that we've been involved with, small initially, so 10 million in size, working with 4 different providers to deliver improved learning for children in India. After a 4-year period, it actually delivered and over-delivered on its targets, improving learning for 200,000 children and delivering an 8% return for investors. Similarly, on the health side, the quality, the Utkrist maternal and newborn health impact bond was around improving quality standards for small clinics in Rajasthan. Again, very successful in aligning incentives. We had USAID, large donor, Merck, a large corporate on the outcome funding side, and investors that we pooled to deliver on that specific impact bond. But building on that track record, we then partnered with our asset management colleague to deliver a blended finance structure where philanthropic capital came in. It's a 100 million fund structure. Philanthropic capital came in to de-risk as a first loss to then attract more commercial investors. So the first, let's say, global blended finance structure focus on outcomes contracts. One example. Moving to nature-based solutions as a second example, we've really feel that that's an area where blended finance can help to scale projects and support the pipeline of investable opportunities. Maybe a very concrete examples of a project that we're supporting in Indonesia. So Fair Ventures Social Forestry. They put concessions with degraded land back to use by conserving high-value forests, generating revenues from carbon credits, and also establishing timber and cash crop plantations on degraded land to actually employ local communities and generate livelihoods income. So building on that model to then create a blended finance structure with different types of concessions throughout Indonesia to attract more commercial investors. So two examples that I'll give. I'm happy to go into more details later.
No, Maya, that is absolutely, that's a perfect setup. And I'm going to come, Parth, I'm going to come to you in a second in terms of a couple of things. What you've heard so far, but importantly, Maya and Melchior both referenced that performance component, whether it was the humanitarian impact bond, which I think was paid back in July that you referred to, or in terms of the performance built into those different structures, the importance there. But if you'll come in from the Pegasus side, which I guess is the private, and I've known Pegasus for a while, and the fantastic work you've done. What are you hearing? And then on that performance piece, that seems to be so important. Parth, the floor is yours.
Thanks, Paul. So let me add a little bit of introduction to what Pegasus is doing. So Pegasus is an impact fund manager. We've been around for a little over 25 years, and we were started in 1995. So over that time, we've invested nearly $2 billion across a variety of sectors, but increasingly in sustainable and health and wellness space. And as part of this journey, we have recently launched 2 blended finance funds, and I sit in one of them, which is the Subnational Climate Fund. And this fund effectively focuses on the green economy in developing countries. And what I mean by that is we focus on 4 specific sectors. One is renewable energy and energy efficiency, waste management and water, urban solutions, and agriculture. And it is a blended finance fund, so I sit on the investment side, and Pegasus is the investment manager, and my colleagues on the R20 and IUCN and Gold Standard side sit on the technical assistance facility. So it touches upon a lot of the points that have been...
R20, might not, just in terms of the acronyms and things,
sure,
bring people to a baseline in the room. I have this obsessional hatred of acronyms,
yeah,
but they can be really useful. Go on,
Go
Parth.
ahead. So it's Regions 20. It's an organization based in Geneva. It's been around for a period of time, and it was started by Arnold Schwarzenegger. IUCN, I won't kind of steal their thunder. I think they're right here next to me.
That's cool. That's cool. That's cool. That's good.
And Gold Standard, I think you're all aware of. It's an impact methodology nonprofit that originally started working on carbon markets, but now is also looking at fund certification.
Perfect, Parth. Thank
Yeah,
you.
no problem. So in terms of where we are, I think what the SCF is aiming to do is touching upon a lot of the things. So on the technical assistance side, we are funding early stage studies, environmental and social reports, and really providing capital that can build projects in 2 to 3 years from now. Now, will all of them result in actionable projects? Maybe. But the idea is to provide funding at this stage so that they become real. I mean, I think one example I'll give you is there is a market. We're about to publish a study, so it's on the black soldier fly market. Now, we looked at an investment opportunity late last year, and that kind of prompted us to analyze this market a bit more in detail. Now, it's a very nascent sector. It's a sector that actually started in the Netherlands back in 10 years ago. It's largely focused on US, Canada, and Europe, but there is a market for these insects that can consume anything in emerging markets, and we are looking at it to see if there are investment opportunities that could come a few years down the road. But that's an example of funding early stage pre-feasibility studies to kind of put on the capital side. Now, coming to the investment window side and how these two sectors kind of blend together is, in addition to the black soldier fly study, we've also looked at the commercial industrial rooftop market in a number of countries. And we're actively looking at opportunities and considering them in quite detail in countries such as South Africa, in Indonesia, where there is a lot of the existing grid runs on thermal capacity, and we're effectively investing in rooftop solar platforms that can invest and convert the existing customers that basically offtake their power 90% through thermal coal to renewable power, to mobilize investments into these spaces. Because the way we are structured as a fund is for every investment that we do, we need to meet 3 SDGs. And in these sectors, it's fairly straightforward because the impact that we are creating in these opportunities. But we take impact and what we are doing here quite seriously. I mean, there are a number of opportunities that we have considered that we have passed on because it doesn't fit our fund's impact mandate, even if the financial returns and the business case stands up really well. So when we look at opportunities on the investment side, it's on 3 pillars. One is the impact pillar. Second is, does the business case stand up? And the third is, do the returns stand up? If those 3 check boxes, then we take the proposal to our initial investment committee, and then obviously to due diligence, and then if it works out, then we'll make the investment. But let me pause here and kind of give you, I touched upon a couple of concrete examples, and I'm happy to take questions in this regard.
Parth, just a very quick rider, and I'm coming to Tobias from Swiss Re next, and then Dorothy from IUCN, you will sweep in and give us that international organization view, okay? Parth, in terms of the performance piece, right, just very brief answers, the performance piece that a couple of the speakers have referred to, but also the sort of the crowding out bit. Just very briefly on both, and then we'll go to Tobias.
So on the performance piece, I think what I would say is on the impact standards that have been touched is that we are actually an Article 9 fund within the EU taxonomy, and we are, along with Gold Standard, creating a set of impact standards that our fund will kind of achieve. So our fund will be certified both on an ex-ante basis as well as on a post-ante basis to kind of make sure that the performance we deliver actually signs up to the impact methodology we agreed to on day one. So Gold Standard is actively involved, and when we look at opportunities to make sure that they will comply with that performance, initially they will be reviewing a lot of our investments, and then over a period of time they will do a sample selection. So that's on one side. And I think on the crowding out side, I would say is that we do need more private sector capital to come into emerging markets, and effectively SCF is a fund created for that. I mean, we have $150 million of first loss catalytic capital from the UN Green Climate Fund, and that is meant to be leveraged on a 4-to-1 basis. Yes, I think it is meant to be crowding in more investment into these areas. And to the point on whether we compete with MDBs and other pools of existing DFIs there, I think one advantage that funds like ours have in this space is think of us as effectively like a private sector DFI. We achieve the same impacts and methodologies because we are complying with IFC performance standards. But 2, we move at the speed of a private equity fund.
Okay,
so
Parth,
actually deploying capital.
That again, another perspective, really useful. A yes or no answer, and only yes or no. You have one choice. It's a binary. Was it easy and efficient to get money from the Green Climate Fund? Yes or no?
I think it's a process.
That's 2 answers. You failed on that one. Sorry, Parth. Listen, thank you for that input. Tobias Meyer from Swiss Reinsurance. The floor is yours in terms of what you've heard coming from the bigger institutional side, perhaps. What's your take in terms of blended finance?
Thank you. Let me just say, so I work for Swiss Re, a global insurance and reinsurance company, and what I'm going to say is it doesn't only apply to Swiss Re, but I operate in a market, if you will, that blends private capital and multilateral capital. And so I'll give you two examples. One was a recent a commercial loan to a government of a sub-Saharan African country who were going to use the proceeds of this loan, $1 billion, to improve the water systems around their capital. And so you have a consortium of banks who are interested in making this loan and in providing this financing in principle. Sort of you should imagine this is like a project finance transaction, right? 15-year tenor, that type of thing. But the only reason that they're willing to lend to a sub-Saharan African sovereign 2 years into the pandemic is that a multilateral provides what's called a partial credit guarantee. So they'll say, listen, if this government doesn't repay you, the lenders, then we'll make you whole, right? So this money would not flow, period, without this instrument. And where I come in is that these lenders then say, well, so 50% of my loan is covered by this multilateral, which has a AAA rating, a preferred creditor treatment, which completely mitigates the sovereign risk because these governments have no interest on defaulting on anything provided by a multilateral. But I want to cover my loan up to 95%. And then they enter into the insurance market where companies like mine provide what's called sovereign non-payment insurance. And so that these commercial banks, it's a consortium, they effectively buy insurance, combine it with this multilateral instrument that really only an MDB can provide, and that unlocks this financing. The alternative would be no financing, no improvement of this water system, or that they simply get a loan from a multilateral, which they obviously do, but there are always reasons why multilaterals cannot finance everything themselves. And the second model in which I actively engage in all the time is sovereign governments following years of technical assistance to better understand their own sort of contingent liabilities that arise from climate risk. So think about Caribbean islands who face hurricane risks, the Philippines, heavily exposed to earthquake and tropical cyclone risk and so forth. These countries receive technical assistance from the multilaterals and others on how to quantify that, think about that, create maps, better understand these phenomena. And a subset of these countries ultimately decide to transfer a portion of that risk to the market. So effectively they buy sovereign insurance, if you will. Right? And it's not the only measure they do. They typically also set up rainy day funds that they can tap into following such an event. But the reality is they need surge funding when a strong earthquake comes along, when a hurricane devastates in the Caribbean islands, and so forth. And so in the execution of such transactions whereby a sovereign government effectively buys insurance, it's typically not an insurance instrument, but it doesn't matter, those transactions not only happen because they have received technical assistance to better understand this and take this very calculated step, but the transaction is also intermediated by a multilateral. In other words, you have two contracts. You have one contract between the sovereign government and the multilateral, wherever they are, be they in Washington or wherever, and a second contract between that multilateral and the market, right? And so Swiss Re is one of the players who can ultimately absorb that type of risks, and many times we simply structure these transactions and they are syndicated in the capital markets where they are an interesting asset class that is not correlated with the economic cycles.
Tobias, perfect. Dorothy, I'm going to bridge to you in a second, but I'm putting the audience on watch. Is everyone in the room an absolute expert on blended finance? You know everything and you understand everything which has been said. Show of hands. That's good, because that means you're going to have questions, okay? Not the experts, the rest. So I'm putting the audience on watch in terms of if you're, what's the word for it? No, that's not a polite word. But if there's anything that you're not tracking here, we will come in a short while to the panelists and the keynotes, all right? So you're on watch as well. I'm just trying to set up a little bit of tension here. It's always good in a meeting. And so think of your questions and let's have them delivered ruthlessly with a smile, okay? And I'm going to come across to Dorothy. And Dorothy, thank you for your patience and for waiting. But I left you as an international organization, not yourself, IUCN, last in terms of coming at coming in some ways from 100,000 feet, but you've got real, we had a conversation before this meeting, you've got real expertise on the ground in terms of how you deliver funds and what mechanisms can work between public and private and how we can scale those. So what have you heard? What is giving you joy? What is giving you concern? IUCN, the floor is yours.
Great. Thank you so much, Paul. And I'll actually take the challenge with the GCF. No, it has not been easy. So we can elaborate on that. It's certainly a big piece of the puzzle of blended finance. Very extremely interesting. And IUCN, for those, and thank you for not stealing my thunder, it's the International Union for Conservation of Nature. We exist since 1948 and are a membership organization. So we have governments, entities, NGOs, more recently also Indigenous Peoples Group, as well as subnational governments as our members. And we have a 4-yearly congress where sort of the big conservation agenda, biodiversity, and so forth is being set by the global community. Yet, of course, most recently, and what we see in big reports is that public finance, philanthropic finance for conservation is not enough. So, of course, our ultimate goal is that we want to conserve, protect, restore nature, sustainably manage our natural resources, but how do we make that happen if there is a shortage of the public and philanthropic money? So of course we go also work or look much more to the capital markets. And I think here there is a wealth of opportunity. Of course there's also risks involved. There is bad press in that sense as well in terms of greenwashing and so forth. So we shouldn't negate that. But I think we have as IUCN, I think really an opportunity to work with the various financial players specifically on the impact side. So we don't not only work, for example, with the Subnational Climate Fund, we are managing the technical assistance around the feasibility studies, capacity building. We work with Gold Standard on the metric side to reduce the risk to biodiversity. So climate infrastructure has likely some negative impacts on biodiversity. So how do we deal with that? But the flip side is how do we integrate nature-based solutions? And that was already mentioned by my colleague from the UBS Foundation. So there, nature-based solutions, very quickly, it's about the conservation, restoration, actively of ecosystem for societal challenges. That could be climate change, biodiversity, food security, and so forth. But that's easier said than done. So I think we heard also from the colleague from SECO, TA and those projects take time. They take a lot of time. And I think there we need to be realistic. If we do it right, specifically also with the private sector, they have really huge opportunities. But I think what we see is, for years in the conservation world, there's been a certain mentality of also why people work in the conservation community. They speak a certain language, not the same language that's been spoken here. I've been trying to do this finance work for the last 5 years, and I'm sometimes still like, I don't understand that. Can you please explain it? And I think that is what we, as IUCN, are also trying to build our bridges with the finance community of how we bring biodiversity conservation and sort of the financial side together. Quickly on the examples, sorry if I took out a bit longer there. So we have, as we said before, we're working with Pegasus and our colleagues from our 20 Gold Standard on the Subnational Climate Fund to really identify those projects where in an ideal world we have an infrastructure like renewable where we can add nature-based solution actively in the business model. So not just as a side effect of a CSR, sort of corporate social responsibility type investment, but actually see how that will work in practice. And quite frankly, the verdict is out how that will work in the long run. A smaller a smaller effort that I'm engaged in, as you can see, I'm coming from the ocean side. We are running also smaller technical assistance where people ask me, oh, is it an incubator, is it an accelerator? I'm like, I don't care. I want to help the people, the project developers, the social enterprises on the ground. And that's where we always say de-risking vis-a-vis private capital. But I'm always saying, well, these people on the ground are taking a lot of risks to sort of try and come up with this new business model, really integrating nature-based solutions from the get-go. And I'm trying to help them along the way to attract different type of capital. We had a fantastic project in Belize where the core is tourism. It engages also with carbon credits. It's in a marine protected area. So we went in with grant money through the Blue Natural Capital Financing Facility, which is backed up by government money. And for example, the Sustainable Ocean Fund put in a loan. So we were able really through that sort of means to fund efforts of that project development phase that the Sustainable Ocean Fund alone would not have done. We have projects in the Philippines, again, the business model running around seaweed farming. They have plastic recycling, carbon as well, again, in an MPA with local communities, creating new jobs. And I think that's also the reality where I'd like to hear from our colleagues from the insurance company. They just got hit by a hurricane, or typhoon in this case. And the seaweed farms wiped out. So how do we deal also going forward, we know specifically in the coastal zone, this climate change impact will happen. How do we build that also into these new business models? Because we know there's a lot of buzz and talk about nature-based solutions. So how do we move these billions from over there to the currently 1 to 5 million project deals? And I think that is also the discussion we need to have of this bridging. How do we bridge from the billions down to the current projects on the ground?
Dorothy, brilliant. We're going to the audience. I'm going to take 2 or 3 quick questions. There are no statements, there are questions, and if you can introduce yourself very briefly, and ideally tag it to one of the panel or one of the keynotes, that would be super. So can I have any hands? The gentleman in the light blue shirt, followed by the gentleman in the jacket, and then another gentleman. There's not much gender diversity, but they put their hands up first, okay. So first question, and we'll take the questions. Please tag it to a panel member.
Sure. My name is Elko. I do board work, and I work with a lot with entrepreneurs. I want to connect to the last comment of Dorothy about how do you bridge billions to millions. I come across many entrepreneurs who have solutions. They are for-profit solutions. They are brilliant ideas. They got good teams. They even post revenues many times. They're looking for seed, maybe Series A. At the same time, you see foundations and VCs which sit on a lot of dry powder. The money is not flowing. With respect for all the great examples that we've heard, the money is not flowing. They're very frustrated. How do we get money flowing to those entrepreneurs who are, as I say, for profit doing great projects? And we shouldn't be stay stuck in things like policy discussions and big tickets. I just spent an hour recently with a large investment manager. So, in the end, after an hour, we only do tickets of 50 million. Yeah. And I say, well, listen, we're looking at 1, 2, 3, 4, 5 million deals that I'm pitching for. It's very frustrating to a lot of entrepreneurs.
Elko, do you want to tag that to someone? Or?
Well, I picked up on the comment of Dorothy, but I'm also looking at the lady from UBS, who's heads up a foundation. Maybe others have also solutions to this
Maya,
topic.
we'll come to you on that first question in a second. We'll take the second question, the gentleman in the jacket here. And so, Maya, that's for you, the first question. Elko's point.
Yeah, jackets aren't unusual in this conference, but anyway. Paul McIntosh from Asia Asset Management magazine. This is specifically addressed to what Dorothy was saying about risk, but it's not necessarily to put her on the spot, because it's for the whole panel. Solutions about quantifying risk for these kind of opportunities, because this is surely the way to unlock those capital flows, by providing actual, quantifiable risk metrics that investors who do have fiduciary responsibilities, such that they could be criminally prosecuted if they expose their investors to too much risk. I mean, the pension funds and other, owners of the money. They need to have risk, quantifiable risk metrics so that they can start deploying all the capital into these projects. What kind of solutions and what kind of metrics do you see being developed that are most credible to do this?
You know what? 2 really good questions. So we're going to take the response, and then I'll come. The lady on the right, I didn't see you, so we've got another 3 questions. But Maya, if you want to take the first one, and does anyone, before I nominate, does anyone want to take the second question on risk metrics? I'm looking for eyes. Melchior, I'm afraid I'm coming to you on that one. Okay, good. Maya, the floor is yours on the first question for a relatively brief response. Okay.
Sure. So thanks for the question, and I think it's about finding the right pots of capital that are willing to give those smaller ticket sizes, and it is usually the foundations or also the angel investors through accelerators, incubators that will provide that early stage capital. If you're going to larger fund managers, they will not be able to provide that capital. So, I mean, I think we can give you we provide that early stage capital to entrepreneurs in our areas of focus. There are certainly a lot of other foundations that do the same. And I think...
I'm shaking my head because, I see entrepreneurs begging on their knees. They go round and round, and the answer is, it doesn't fit in our allocation policy. Come back when you got $1 million revenues. Come back when you have a lead investor. I can give you 5 more answers of what you get. So I hear what you say, and conceptually that's all right. But on the ground, it's not happening enough.
I mean, there's certainly always more that we can do. We partner with other foundations that think along the same lines. I can mention the Omidyar Foundation. I can mention the Children's Investment Fund Foundation. We work with Rockefeller. And then we fund also these incubators that also provide funding for early stage entrepreneurs.
So bridging, Dorothy, come in on Elko's question. But look, we're capturing a really good theme there in terms of it's about the transmission and delivery at speed with minimized bureaucracy and actually getting the money into the pockets of the entrepreneurs who are doing it on the ground. That's the ideal. But it's, in your mind, Elko, not working far from perfectly, but that's a conversation we've got to focus on and begin to dig out those details. I will come back with a personal example later on, which absolutely meshes with yours. So, Maya, thank you. I love a bit of tension in the room. It's just good. We never want blood on the floor. Dorothy, come on in.
Yeah, just to adding to that one, I mean, we act as a TA with grants, but I think the way we function is that we run call for proposals, which came up in the introductory remarks as well, and we have obviously more requests than we can serve also with the money that we have backing us, basically, right? So it's also about how do we grow certain mechanisms that can help that. But we have seen, I mean, we leveled our expectations from, we started this 5 years ago. We had these great ideas and we would get our return when the deal is closed, et cetera, et cetera. Well, that didn't happen. We just took it very quickly off the table because we ultimately wanted to help the developers. So we said, they have enough to do, let's give them the grant, let's revisit this model in 5 years. But it took some of the projects really 2 to 3 years to close this deal that we wanted, or that we have helped them on the road. And I think there's really this need to look at what type of, I mean, we've been working with some of the publicly backed investment funds that are quite, smaller in the conservation world. But that, I think, again, I don't know which type of entrepreneurs you're looking for, but that's the model I've seen working.
Dorothy, Maya.
So quickly to add,
very briefly,
there are also increasingly bilateral governments that are also funding, providing funding for smaller scale investors, smaller scale entrepreneurs. So I think it would be interesting to have that conversation in terms of what are the entrepreneurs from your experience that are actually not receiving the funding.
There's a direct bilateral conversation afterwards. Look, thank you. Melchior, I'm coming to you in a second, but we're taking that third question so I can actually think on my feet and tag it to someone. Very quick third question, then Melchior on metrics. And also, I think Christian's got his hand up. Sir.
Thank you very much, Christoph Zuckerberger, Professor of Ethics and in Ethical Investment. The risk and de-risk issue. Shouldn't we change more from de-risk language to shared risk? Because what you said also from IUCN, I mean, the people on the ground have already a huge risk that they share daily. So your comment on that, also from Swiss Re, because you are the risk manager per se, Swiss Re, so to say, with the insurance. And the second is the question of acceleration again, of decision making. There was the type in the past, the governments are slow and the private sector is fast. It's no more as simple as this, but I think we all have the challenge how to accelerate decision making. When I hear it takes years and years, and it's also my experience, from a first proposal to really an investment, how can we accelerate that? So risk and acceleration.
Okay, perfect. Thank you. So Melchior, we're coming to you on risk metrics. I'm going to tag that third question both to Christian, but also to Parth in terms of specifically the acceleration piece. So Melchior on the risk metrics, and maybe touching on that issue of going from de-risking language to shared risk. Melchior.
So I don't know if I really answer to your question, but the Subnational Climate Fund is a perfect example on how we can de-risk and attract senior money with that junior tranche of the Global Climate Fund. So of course there is a gap between financing and the deal flow, and we need to build up progressively, and that will be a bit the role of the R20 Foundation. R20 is a huge network of subnational entities, and the foundation could attract millions of deals in asking Arnold Schwarzenegger to turn around in countries and say, okay, let's showcase. The foundation is ready now to screen those deals with a specific metrics and things like that, but there are not enough capital so far. So I think it's a long road. We need to attract more junior tranche in order to de-risk and to make aware pension funds, big family offices, endowment, that there is proper risk return and impact metrics into those new investment. But of course, so far we are overcrowded by deals, and it's difficult to follow.
Thank you for the view from the market. Christian.
Yeah, maybe a point or 2 points on quantifiable risk metrics. I think this is really a critical point, because this would be a systemic contribution into lowering probably the cost of capital for the private sector to invest in emerging markets. And I think one point is that we have on our radar is that the global emerging market database that multilateral institutions have, that this should be made more accessible for everyone. So it's partly, but I think it needs to be more broadly accessible. And I think it's exactly that kind of systemic contribution that we need. And second, I think one point is also the track record that some funds need to build up, and sometimes it just takes a lot of time. Yesterday we discussed with the private infrastructure development group that we support, for instance, the Emerging Africa Infrastructure Fund that now exists for 20 years. So this is a track record that is established that also allows for a rating, and so once it's rated and has this track record, it becomes more attractive for institutional investors. And I think, yeah, in some cases we need to also establish that track record and see, like, when do we hit that these critical thresholds.
Christian, thank you. I'm going to come to Parth in about 10 seconds. Look, panelists, right? I'm of Irish Celtic origins, so I don't like too much structure. And what I've got here in the audience is a problem of too many people asking questions, which is wonderful, but it means I have to work. So putting it back on your basis, if you want to jump in, rather than me tagging people, you've got to put your hand up, okay, and jump in. So that's... Oh, well, we can deal with technical issues. Oliver, could we get another mic so the... Okay, all right, there's 4. So what have we got? Okay. All right, but you'll manage, won't you? I'm sure Optimus will manage the mic situation well. So where are we? Good. Parth, you're going to come in now, and it's that issue in terms of the speed and acceleration of it's partly Alco's point, but it's the speed and acceleration of money into the market, into the entrepreneurs who are delivering the social and environmental value and economic return. Parth.
So let me touch upon 2 points, because I think I also want to touch upon the seed question that came earlier. So, because I sit on the investment side and I look at proposals pretty much every day and see which ones I'm going to take forward. On the acceleration of investment, it really depends on the entrepreneur and the company on how prepared they are. If you just come with a concept to a fund and expect funding in 6 months, it's never going to happen. So the question is, are you ready for investment? And that takes time. You have to have a team, you have to have a process. And look, I am not a seed investor. I come in, I'm an infrastructure investor. So typically infrastructure investors do both greenfield and brownfield investments, and that's what I do. But if I'm talking VC language, because that's become the norm in the last 10 years, we effectively come in at Series B and above. We come in at a stage where our minimum ticket size is $5 million, all the way up to $75 million. And our thesis is we are helping companies institutionalize themselves. So they have raised a little bit of money, they have a little bit of track record. We're not asking all of them to be profitable at this stage because we understand there is a bell curve. But in that journey that they take with us, we are investing in assets. I mean, I'll give you a good example. We are actively looking at a CNI company in Southeast Asia that has raised a bit of capital, has put some assets on the ground, but we are going to come in and help institutionalize that business, help them transition from being a pure developer to an owner-operator. And we think there's a good investment case for that, for making that happen. But we're also going to inject some TA capital for their super early stage projects to fund pre-feasibility studies, so there are opportunities to fund in 2 to 3 years from now at a larger scale. But this investment is going to take, it has taken a long time to get there because it is complex to kind of structure these things. But as I say, the company has to be ready. In my experience, I've been doing this for a while, but in the 1 year that I've been with Pegasus and with the Climate Fund, because the Subnational Climate Fund only really started operations in May of 2021, the limitation has not been our speed of execution. The limitation has been, does the sponsor, does the company have enough information? Frankly, most of the time they don't. So it's not that the funder here is of limitations. Usually I'm chasing people if I find a good opportunity on where their information decks are, where their flows are, is their data room ready, can they attract investment? And that takes time.
Parth, let me jump in there. So that, in some ways, there's a TA part there in terms of entrepreneur, and it's always been around. Entrepreneurs on the ground with good ideas, being prepped and actually targeting the type of investor and the stage and phase they're at. Is that a fair comment?
Yes, if by TA we mean just by pure project preparation at an early stage, sure. But there's a slight difference, right?
Yeah.
Because if you are just looking for seed investors or early Series A investors, that's a different context. You just have a deck, an idea, and a couple of guys, and they want to execute on something. But when you come to investors like ourselves that are coming in effectively at Series B and above, you need to be a bit more prepared.
Got you.
But let me just couch that. There are sectors where we do a little bit earlier. Why? Because the sector doesn't exist. I mean, a classic example is in the e-mobility space that we are looking at. I mean, the space is only 3-4 years old. If I want Series B investments, I mean, I'm going to have to wait another 5 years.
So, Parth, having castigated you earlier, I'm castigating myself. TA, technical assistance, good. And Parth, CNI company. What's a CNI company?
I can't disclose the name.
Okay.
But I should be. What is CNI? Commercial and industrial.
Good. That's great. We're baselined again. Okay. Am I missing any response? I don't think so. There's a quadrant in this room which have just absolutely knocked it out of the park. And if I'm facing that way, the bottom 4 here have all got questions. So the other quadrants in the room, a little bit slack. We've got 5. We're not going to do them all. I think we'll be out of time. So I'm going to beg short, sharp questions, ideally tagged, but if one of the robust panelists wants to jump in, that would be great. So the gentleman in the second row on the left, and then we'll go to the lady on the front row. Thank you. And the time is flowing. Does the panel feel the time is moving quickly? That's good. So keep your question brief.
Gerard Cheong from the Australian Department of Foreign Affairs and Trade. Christian, good to work with the Swiss on PIDGE and Convergence. Fantastic. And lovely to be in Geneva. Message for, I guess, Maya and Parth. Parth, I have a place for you to put your worms in Indonesia. So I'm based at the embassy in Indonesia. I work on infrastructure, water, sanitation. We do roads also. The question is, for water particularly, one of the key bottlenecks, key challenges for us for investability are the complex regulations and policy around water sector in Indonesia. How best can we work with you guys on that environment?
Okay, let's take the second question, and then we'll answer those two. So the lady on my far right. Thank you. And sorry for missing you, and thanks for being patient.
No problems. Oksana Tkachenko. I live in Australia. I've got my own business in blended finance. My question is to Path, specifically if you can give examples on water and sanitation sector investments and what is the return. And then the question was for Christian in terms of how much would you charge for the sovereign debt insurance?
Perfect questions. Path, you're very popular. So I'm going to come to you first and then across to Tobias wants to come in on one aspect of this. So we'll take those two questions first and then the remaining two and the fifth in this same quadrant, nightmare quadrant. Okay, so Path, over to you.
On the water policy question, look, I think water in emerging markets generally, not just taking Indonesia, but it is a nascent sector. I mean, if you look at water, a lot of the investments have happened in the desalination side. A little bit has happened on the wastewater side. I mean, Africa, which I'm a bit more familiar with, is a classic example where, you know, in the last 10 years, you can count on your one hand how many private sector water projects have actually happened in the whole continent. I mean, that's 54 countries that we're talking about here, maybe a bit higher if a couple more get independence. But that is one thing. But I think one area where I have seen movement is if you can make the water sector as investable as it's on the IPP side or on the power sector side. And it has to be, where can you actually attract private sector investment? Is it on desal? Is it on wastewater? Because if you expect the private sector to come in and lay pipes, I think that's difficult because that means the right-of-way issues, land acquisition issues. That is the job of the government and the state utility that has to pull that off. But if the private sector can basically do a ring fence investment, whether that be in a wastewater treatment plant, or if rights-of-ways have already been acquired and you want the private sector to lay pipes, that's doable. But the private sector is not in a position to kind of go out and do significant land acquisition to lay pipes to give potable water to communities. So I think it's on identifying pieces where you think the private sector can deploy capital. On the second point, I think I got the return.
Path. Okay.
On the second question, I only got the returns. What was your first part?
Can you give an example? Can you please give an example of the water or sanitation investments that you handled and what is the return?
So look, we have been looking at this space on the water and sanitation side. It is challenging to find investable opportunities in this space. That is the honest reality. A few have come across our desk. We are looking at, I think we are had early stage conversations on a couple of desal opportunities in West Africa. But as I said, they're at very early stages.
Yep.
So hard to find.
Perfect on that. I'm going to go to Christian now, and then I think Tobias was agitating with to give an answer. Christian. Oh, sorry, forgive me then.
I think the question was around how much does sovereign non-payment insurance cost? So there is no answer to that. Well, would you expect there to be an answer to that? I mean, it depends obviously on factors like maturity and underlying use of proceeds and the government itself and so forth. The much more broader point for me is that we're talking about large amounts, so these are not small ticket sizes typically. And the appetite in the market, and I don't say this on behalf of Swiss Re, I'd say this on behalf of the insurance market, is in many instances, particularly emerging markets, created by sharing that risk with a multilateral who completely mitigates this risk. And that also brings down the price of the risk. So if you were to say, how much does it cost to insure, I'm making this up and I apologize, I have to give you an example. South Sudan sovereign non-payment insurance, there is no market for it, period. But if you were to say, well, how much is it if the IBRD or IDA, covers the first 50% of that, then maybe we can get to a price, right? Because insurers will say, well, if they don't repay, what am I going to do? I'm going to take, the government of X to court in their own country? It's hopeless, right? So there's no impact that we have. But in a multilateral, we'll say, excuse me, government of X, you still owe us, X, Y, Z, and that has a completely different reaction, and that unlocks the market that I operate in.
Perfect. Does anyone else want to, Christian?
Maybe quickly, taking advantage of your Celtic nature, I go back to one of the questions before on VC, venture capital.
Thank God for Swiss structure, that's all I'm saying. Christian, thank you. The Irish and the Swiss are unbeatable together. You go on.
No, I think just generally, I agree that there's certainly a lot of work still to be done in that area. But just to mention two quick examples, I'm not sure if they would fit with what you're looking for. But one is the SECO Startup Fund that provides loans to up to $500,000 Swiss francs. The constraint is a bit that some assets are in Switzerland, be it of the company or of the person, because it's a public contract and we need to be able to enforce it. And the second example is from our colleagues from SDC on social impact incentives, saying that they did quite some interesting work with Roots of Impact, which kind of supports startups to keep their mission with the social social performance kind of alive, because often we see then a mission drift to becoming too commercial and leave the social or environmental, the public good aspect, so to speak, aside. And this support is actually an incentive and a performance orientation that allows or avoids this mission drift and keeps the startup maybe afloat. Yeah.
Okay. Everyone in the room take a deep breath, all right? And the panelists as well, because this is already a rich conversation. There's a lot to unpack. So we've got about 25 minutes before the end, so we need a big sort of arrow so we can, focus down and doesn't become what's the word? Fragmented, right? But there's a lot already here. The three additional questions, you're going to have to be patient, and we're going to hold for a moment. So what I'm speaking to the panel now, but everyone's taking a deep breath. We've got 25 minutes left. We've got to save the world, but we'll get there. Okay, and the entrepreneurs, Helco, I think. In terms of the sort of cross-cutting themes coming out here, in my mind, and I'm asking for more from you, there's obviously the speed of delivery of funds into the ground, into the market. Okay, key issue. There is this sort of, in some ways, the labyrinth nature that looking up as an entrepreneur from the ground, in terms of, I've got a good idea, I've got a business, but to go to the Swiss, to go to the Australians, with the donors, the grants, the philanthropist, all of that ability to help entrepreneurs do what Parth said, which is prepare, know the investor that you're going to because of the phase of your company, and make it time efficient. I believe there's huge amounts of work to be done there, okay? So speed, preparation of the entrepreneurs, in terms of, I think, Christian, you referenced in your opening comments that in terms of the multilateral development banks, the need to move from originate to distribute model, which was joy to my ears. And just let me throw on the table one comment, and it's a bit unfair. Is anyone from a multilateral development bank? All right, so I'm going to just, that's good, actually. So South African engineer, who'd put more infrastructure into Africa than I think any human being, right, over many decades. And a comment which he made to me a few years ago and resonated was, multilateral development banks, slow, a little bit arrogant, expensive, but they are the devil we had to deal with. Now, that's not my words. That's the commentary in terms of the multilateral development bank sort of ethos and ecosystem, right? So, for the panelists, let's just take a few minutes out here with some brief thoughts and comments in terms of, those are the themes I'm picking, but what are you individually seeing as the key issue in a very complex space, in terms of, if you woke up on Christmas morning or whatever holiday you celebrate, and you had the answer, what would be the ask? So I'm going to just go, from Tobias across, okay? It's a little bit false, but it helps us all take a breath. Agreed? You've got to agree properly. Agreed? That's better. We'll come back to that quadrant. Tobias, what's the thing we need to do?
I'm going to take the liberty not to so much answer your question.
I like that. That's
but
perfect.
Add an
Perfect.
observation, which I think is important, sort of on an analytical level, is that blended finance means different things in different contexts. We have, when you say blended, you really haven't said so much yet. It could be public money, private money, it could be philanthropic money, and so forth. And we're also talking about very different challenges or very different sectors, and I think a bit of nuance is important. So the gentleman had questions about what sounded like private equity or private debt. I'm talking about, you know, sovereign financing. So, you know, we use this term, this category, blended finance, and we all touch it and work sort of in it and claim it to be working in it, but it's very different things in different contexts. And so there may not be that one answer to the questions that you raised.
But it wasn't a question in that way. It was, if you wake up on Christmas morning, what would be solved, right? And it's in your own institutional context. I'm coming back at you. And then we move to Christian. But you take a think, Christian. And it's a very simplistic, childlike thing, but you're right. The labyrinth of blended finance is a nightmare. Christian. Pass it on to Melchior.
No, I think going back to the multilateral development banks, I think that's really a discussion that we probably, and I'm talking as Christian maybe now, and hopefully this is not live streamed, I don't know, actually. No, but I think, as I mentioned before, I think that the TA part of multilateral banks that should really continue to be seen as key. So the whole work on policies and systemic issues always tackle this first. I think that there should be an agreement about this, that we should first focus on framework conditions, on policies, on systematic issues, which I would include also the work on data, transparency, etc. And then on the originate and hold versus distribute and hold, I think there we need to continue working, because we can leverage the multilateral development banks much more, I think, going forward, but it probably needs some adjustments in terms of governance and incentives internally, and they're all shareholders of multi-development banks, and the multi-development banks themselves are kind of accountable for to wake up at New Year's Eve and say, like, we have it done, and I think that's certainly an agenda for the coming years.
Thank you for your view. And Melchior, we will come back to Tobias, because I think we're almost landed. Melchior, I'll stop using Christmas unless you want to.
So yeah, Christmas tree is a good example for what I will say. I will speak under the supervision of David Albertani on the dream and the vision of R20 Foundation, because I think that foundation can really bridge a very significant gap. So the foundation is now fundraising for additional donors' money for helping, like for the SCF fund with IUCN, to enhance quality deal flow and make them close to be investable. So we have a lot of interest of donors saying, okay, let's do that. And then the challenge will be to be able to be connected as a platform of subnational, enhanced, engineered deal flow, a global deal flow from 5 million to 75 or more, so small scale, and to connect with the capital market players. Macquarie, BlackRock, Lombardier has a project there in that field. Blue Orchard is launching infrastructure base of the pyramid fund. So there are plenty of actors in need of quality deal flow. But the cost of structuring those deals, engineering those deals, is too big to be paid by the capital market mechanism. So our vision is really to tap into big donors' money. Maya, maybe you might help us for enhancing our technical assistance facility. And then through the R20 network, we are able to attract thousands of very interesting deals. The French government approached us and granted us a donation for thinking about a feasibility study for a fund on Mediterranean regions. That's an example. So there are plenty of donors able to build up that dream and vision with us. So maybe in Christmas we can celebrate.
Melchior, perfect. Now, the challenge, because we've got couple of questions, but this is the way we're going to do it. So we're going back to Tobias very briefly. Then through the three, Maya, Dorothy, and Parth. And we'll try and be greedy and take a couple of the questions, if not all of them. Are people cool with that? Good. Okay, so Tobias, you're on the microphone for a quick answer.
Do we have a choice?
No.
Okay, so, at the risk of sounding abstract, which I don't want to, it's going to be conceptual, I think, my answer. It may not be for this Christmas either, maybe for next one. But
you're thinking ahead. You're
okay.
organized. That's good.
Right. Generally, working at the intersection of public and private, where I work, and which then results in what we then, once it happens, call blended finance, effectively, you observe that both sides are inevitably stuck in their, in their industry, in their terminology, they have reflexes, right? And so somebody like me is constantly kind of trying to counteract those reflexes or sort of provide information why, perhaps in this case, it could be done a different way. But when a sovereign government, just to go back to that original example, when the government of Jamaica last year, for example, decided to place hurricane risk in the so-called insurance-linked securities market, right? They don't wake up one day and say, hey, let's do this, and then they call us, and then that's not how it works. It takes a long time, and that means that a lot of people who provide technical assistance, who provide guidance, maybe there's a broker involved on our side, have to kind of think about this, the ultimate objective here, and how are we going to get this done, and what do we have to change for this to happen from a more traditional transaction, right? When the other end is not a minister of finance who is inevitably going to be under super high scrutiny for how he allocates money and why they take the choices that they have to take and so forth. And on their side, I think it also, and I'm not talking about the government of Jamaica at all, but just the general counterparties, they have to at least conceptually allow for this idea that somebody is going to price whatever they're investing in or whatever risk they're taking in a way that in the long run probably yields a profit.
Tobias, that is perfect, and I appreciate the thought into that. Maya, UBS Optimus Foundation, over to you.
Thank you. So I think I want to come back actually to a comment that you made, Tobias, is like blending for the sake of blending. What are we blending for? And I think here on this panel, I don't think we're all on the same page in terms of why we're blending. So I think one of the key things that I would like to see, and the kind of to your point around what was the big ambition is, well, what are we trying to achieve in terms of impact standards and a set of a common baseline of what are we trying to achieve with that blending. So the piece around impact measurement and impact standards and impact benchmarks, I think is critical for this whole ecosystem to work. And I don't think we've cracked that nut. There's a lot of fragmentation around different sectors and different bodies doing that, but I don't think we've cracked that nut. The other two pieces that I want to mention is one on the investable opportunities and the lack of pipeline, and back to the gentleman's point around different types of funding providers that can accompany that pipeline along its life cycle, so to speak. And the other piece that I think is critical is having funding to help structure deals, bringing the right people around the table with the right type of expertise. And so that is making sure that you have the experts on the ground like IUCN, you have the fund manager that knows how to deploy the money, but how do you bring that all together so that there is because ultimately if you want to deliver on impact, you need to have that collaborative group of people and if someone that has the right expertise in all those areas, and I think that is still missing.
Maya, absolutely spot on. And Dorothy, so SDG 17 collaboration should be SDG 1, right? Do we all agree? Good, because collaboration is the only way to get to the rest of the SDGs. But I'm not going to overhaul the multilateral system in this seminar. So Dorothy, my thank you for those comments, really pertinent, hitting it on the head. Dorothy, over to you. Then Parth, we will take at least one question, so you can have a fight at the moment for now in terms of who goes on deck. Okay. Please, Dorothy.
Well, absolutely what Maya said on the impact side, but I would go with a very well, I'm not sure if it's simple, but the sort of speeding up the translation between nature and finance. I think that for me is still a very big, as I said, bridge to build. And actually sitting in meetings, and in order to accelerate some of the progress we want to see, is that really from a conservation, nature-based solution side and the financial actors, that we are much quicker to speaking the same language, and a bit of sort of where are we on the same page, and what's the direction we are going to? Because I do think sometimes these worlds are unfortunately still quite apart from each other.
Dorothy, thank you for the brevity. Parth?
So look, I think to pick up on Maya's point, I think the reason why, at least in our view, blended finance exists, and we are a blended finance fund, is for 3 reasons. One, and first and foremost, is to attract private sector capital into developing countries. 2, it's to mitigate FX risk. I mean, if you are a private sector investor investing in developing countries, a lot of your returns are wiped out by FX, because you're a dollar investor or you're a euro investor making returns in local currency. And then 3rd is to invest in more nascent sectors in these countries. And this is what we are trying to achieve at SCF. So I would say if I had one Christmas wish list, it would be that more appetite to invest in emerging markets, in developing countries, and the structures that have been created, and I'm sure there could be other structures that can be created to increase appetite. Because I think that's the only way this approach is scalable.
Fantastic. We're in the last 5 minutes, and this is the way that we're going to finish. So I'm going to choose one question, but the other 2 who don't get the question, I would suggest you approach the panelists at the end, because this gentleman here is watching me in terms of my clock, okay, which is his job. So game on. Thank you, and thank you for all the technical input and all the assistance. Who to choose? I'm going to, could you, I know, but I want you to choose which person takes the question. It's up to you. It's the Australians. Okay. You got about 4 seconds, or you'll be ejected. Yeah. Gentlemen, ladies first. Thank you. Thanks. Brief introduction, and do tag the question. Then we're going to close. This could continue for hours and hours and hours and years, and I think we could use it as a platform going forward and building bridges to unpack a very rich conversation. So please introduce yourself.
Thank you. A lot of pressure for the last question. So my name is Safaya Zaytoun, and I work for a company called Tameo, which does market research on the impact investing industry, as well as one of those fragments working on impact management and reporting. And we talked a lot today about kind of the demand side, but I would like to ask a question on the supply side from investors. We have seen time and time again through blended vehicles as well as private structures that impact vehicles are not losing money. They're doing quite well. We touched very briefly on decorrelation. On the long run, they've been doing quite well. They have positive returns. And yet we still see a lot of people saying, oh, it's too risky to invest in emerging markets. And we have fiduciary duty and so on and so forth. So what kind of is the real bottleneck in terms of increasing investor appetite in this sector? Like, what information is missing that investors are asking for that they don't yet have, or that they are maybe using as an excuse not to invest in this sector?
That is a great question. Thank you very much. Any takers? Oh, you stumped the... okay. Parth, briefly, and then we'll close.
I mean, I can't speak for the investors. Each investor has their own fiduciary responsibility and duty of what their return expectations are. But I think returns, I mean, just making a general comment, I think returns in developed markets have been very strong over the last 10 to 15 years. And if you can make very strong returns in developed markets where you understand the jurisdictions and there is no FX risk, you need a premium above and beyond that to kind of go to jurisdictions that you're less aware of and taking FX and other potential risks. And the reality of the day is that when you go to emerging markets, the returns are not going to be like 50%, right? So if you make 20% in US, you're not going to make 50% in EM. That doesn't exist. So the question is, do you have appetite for the returns that are offered in emerging markets? Because we all play in this space. The returns are what they are for the underlying assets. And blended vehicles and investment professionals can structure and help mitigate these risks. But they are the underlying returns. So I'll pause there.
Perfect.
What about
Maya?
including impact in fiduciary duty? I think that's hopefully the way we're heading.
Did you see Sir Ronald Cohen in terms of the ESG impact quagmire of social media nightmare, which is if we can bring the two together and there's a clear link into the fiduciary piece that will helps not all, but some of the problems go away. So before I thank the panel, I'm going to just, if I may, add a couple of very, very brief observations before Oliver closes me personally down. And again, thanks to yourself and the technical booth for everything. It's been, and Cecilia Serin, wonderful job setting up, organizing. Thank you for that. Look, I had my first startup in Bangkok in 1991 called the Environmental Business Group. Some people said I got my timing wrong. I was actually late, okay, in terms of the way the clock is ticking on climate change. And my observation is there's two positive things. Look, it's one of those rare wins in an entrepreneurial sense. But last week we signed, after 2 years, the paper to take a last mile distribution company from Western Kenya, where we've had the holding for 8 years, into Tocantins province in Brazil. And the way we did it was with a large sanitation company. And the reason they bought into it was that the regulation in Brazil changed around sanitation, that any sanitation company has to provide the same service across all its public mandates. Now that's easy if people are on grid for sanitation. If they're off grid, it's really difficult. What's the solution? Would you believe a Kenyan last mile distribution company? So my point there is corporate venture, I think, is a really important part of the blended piece, which is often not very often talked about. So that's a personal experience. But it was, from a business standpoint, it was really quite satisfying. Final point, I'm normally based in Nairobi. I spend 50% of my time now in London with a law firm. It's called Mishcon de Rea, who are building a sustainability practice. Why have I done that? Why am I interested in that? The law firm specializes in working with private entrepreneurial families worldwide. So typically they might take a family up to the point of IPO and all the needs there and all the different legal things. But that, for me, captures the essence of, I think, the private money, the private entrepreneurial money, and the ability, Christian, for it to be given the entree to the markets. What we're seeing is huge generational shift in private entrepreneurial families and private money in terms of the next generation. They don't see sustainability as an add-on. They see it as the business of the future. I'm being a little bit cliched, but I think it's really important in terms of the private money. So look, let me finish by saying, Tobias, thank you very much. Christian, Seiko, Swiss Re, Seiko, as ever, Melchior de Moralt, who has done phenomenal work over many decades to actually make it, whether it's on the microfinance side or moving any of the big vehicles in sustainable finance. So Pictet, Turretini, and C, thank you. Optimus Foundation, UBS, Maya, great contribution, but again, what you're doing and what you're actually delivering on the ground is phenomenal. Dorothy, IUCN, you swept in, you organized it all, you defeated the Irish lack of structure, the Swiss then latched onto that, and Paul, thank you for bringing a view from Pegasus in terms of, you know, the challenges and the need for the entrepreneurs to prep, understand where they are in the investment chain, who they're asking and how they're asking. But I'd like you all to put your hands together, and apologies, but you can please approach someone with your question. Oliver, I think we're just about at time. Is that right? Thank you again to everyone who's organized, and I think it was a rich conversation. My one plea would, let's bring this back to building bridges. Let's unpack it in, as you've said, Tobias, you know, the labyrinth, the terminology. Blended sounds wonderful, doesn't it? Right? But it's complex and it needs a bit more structure in some ways. Let's put our hands together. Thank you very much. It's been a pleasure.